Today, I want to share with you a great approach for retirees to do both charitable giving, number one, and number two, do so in a way that brings your gross income down in an effort to avoid those pesky Medicare surcharges, also known as IRMAA. That's what we're talking about today. Let's get going. Now, let me start by just mentioning that one thing people like about the tax code is you can get a deduction for any charitable giving that you do. However, if the planning isn't done right, you might not end up with any tax benefits, and that has to do with the way that the standard deduction works under current tax law. And we'll see more about that when we jump into the examples. Now, one thing people hate about the tax code is these so-called Medicare IRMAA surcharges. Basically, Medicare premiums are set based on your income, but most importantly, for the purposes of discussion today, they're based on your gross income. So in other words, even if you're eligible to get a deduction because of charitable giving you're doing, it might not help you out when it comes to those IRMAA thresholds. However, there is a special rule in the tax code, and that's what we're going to spend some time on today talking about. We often refer to this as the Qualified Charitable Distribution Rule, and what this allows people age 70 and a half and above to do is to do charitable giving directly out of their IRAs. And the beauty of this is the way that the rule works is income that would normally hit your tax return as taxable never hits your return. And further, if your planning is done right, you can even bring your income down if you're trying to be strategic and get below some of these specific IRMAA thresholds. So that's what we're going to look at next when we jump into some examples, looking at a couple sample tax returns. All right, let's hop into an example. Today, we're going to look at George's tax return for tax year 2024. We're going to say George is single and he is 72 years old. Now, we're going to look at single tax filers today because the IRMAA thresholds for Medicare surcharges are much lower, and so too is the standard deduction. So I think everything we're talking about here is even more relevant for single tax filers. It's easier to see how impactful this whole concept is, but nonetheless, everything we're talking about applies regardless of your filing status. Next, let's look at George's income composition for tax year 2024. So here's his tax return. We're putting this together on line 2. He's got some interest income, $7,000. On line 4, take note here because we're going to come back and look at this later. He's taken $3,000 a month out of an IRA, which of course works out to $36,000 per year. He's got a pension for $24,000, $48,000 of Social Security benefits. Of course, the maximum taxable is 85% of that, $40,800. So his total gross income is $107,800. Now, take note on line 12, these are deductions, okay? And this number, $16,550, is coming up. That is the standard deduction in 2024 for a single tax filer age 65 or above. Now, of course, all taxpayers have the option to either take a standard deduction or itemize, whatever is the larger of the two. Now, the next thing I'm going to show you here is how, again, if your planning isn't done right, you could do some charitable giving, and if you don't think this through, you might not end up with any tax benefits. Let me show you what I mean. Now, remember, we were just looking at that standard deduction, which for George is $16,550 for 2024. In other words, what that means is if he wants to itemize his deductions, he needs a combination of all deductions that exceed that number. So the issue, however, with many retirees is they just don't have a lot of deductions because many people have their house paid for, so they don't have any interest to deduct. If they're healthy, they don't have any medical deductions. They might only have state and local tax deductions, but those are also capped at $10,000. So if George, for example, was thinking, hey, I'm going to donate $5,000 to a couple of my favorite charities in 2024, great, I'm going to, do my gifting and also be able to take a little deduction for that. I'm just going to show you here how he's not going to be in a position to benefit from a tax perspective. Okay, let me just throw the Schedule A form up on the screen here. This is for basically calculating out your itemized deductions. And let's say, for example, that George had $12,233 of combined property taxes and state income taxes. Again, he's getting capped at $10,000. Okay, that's the only deductions he has aside from these charitable deductions down here on line 11. So the total, if he's capped at $10,000 of state and local income taxes and what he gave to charity, $15,000, that's not exceeding that $16,550 of standard deduction. So if we go back over to the 1040, well, what the tax software is going to do for us is, it's giving us the standard deduction because that's the higher of the two numbers. So my point here is, again, if no planning is done, even though George is giving $5,000, which isn't exactly chump change to charity, he's not getting any tax benefits from doing so. Now, the other thing I want to illustrate to you is how even if George makes a much larger charitable gift in 2024, so he is able to itemize, it's still not going to bring his gross income down at all. And that, of course, is what Medicare surcharges are based off of. Okay, so first and foremost, let's hop over to the Centers for Medicare and Medicaid Services so we can see what those income thresholds are for 2025. Okay, here's the table. So for individual tax filers, here in the left-hand column, here are the income thresholds which Medicare premiums are based off of. And by the way, this is based on modified adjusted gross income, which for the majority of taxpayers is going to be the same as adjusted gross income. But the first income threshold here breaks off at $106,000. Okay, so even if you're just $1 over this, your Medicare premiums bump up from a monthly amount of $185 to $259. And of course, people hate getting hit with these things. Now, one thing I do every year with my clients, the vast majority that I'm doing tax planning for, is we're projecting out, we're estimating what their income is going to be. And we're trying to do whatever we can to stay under these thresholds so we don't get hit with future Medicare surcharges, obviously. But next, what I want to illustrate to you here is how, charitable giving and charitable deductions aren't going to save you from this potential tax trap. All right, so remember what we were just looking at. That first IRMAA or that Medicare IRMAA bracket goes up to $106,000, which means we want to stay underneath that. And I think intuitively, a lot of people would think, oh, well, if I have deductions, that should bring my income down and keep me safe from any Medicare surcharges. I just want to show you how that is not the case, even if you made some huge charitable gift and were able to itemize your deductions. So just for example, let's say George made a $20,000 charitable gift last year in 2024. So now he is able to itemize. His total itemized deductions would be the $10,000 state and local income taxes and the $20,000 charitable giving donation for a total of $30,000. Well, let's just see how that changes the 1040. Well, basically, none of his income is going to change up here. Here's his gross income on line 11. That's still $107,800. Here's that standard deduction underneath. So this is bringing his taxable income down, but what it's not changing is line 11, his gross income. And again, that is the number that Medicare is looking at. It's technically modified adjusted gross income for people who own tax-exempt bonds. But for most taxpayers, this is the number that we're trying to reduce. So next, what I want to show you is how this concept that I mentioned earlier, qualified charitable distributions, can bring this number down. Now, let me just briefly revisit those qualified charitable distributions. Again, this is a provision in the tax code which allows direct gifting from IRAs. Okay, and I want to be clear about that. That means that literally, if you have an account at Fidelity or Schwab or Vanguard, that a check comes directly out of your IRA and goes to a charitable organization, okay? You cannot be in between this transaction. It has to come directly out of the IRA to qualify for this. The beauty is it not only reduces your bottom line taxable income number, It also reduces that top line number, which, as we just talked about, is what matters for those Medicare surcharges or lack thereof. And further, another benefit is this also qualifies or counts towards your required minimum distributions once you're ultimately that age as well. So anyway, let me next pivot over to the tax returns, and I'll show you how this changes the numbers for George. Now, first, just so we can contrast this, let's take a quick peek at our baseline scenario. Basically, where we started out, where George is making he's just writing a check to a charity of his choice for $5,000. He's not getting any tax benefit from that because, as we discussed, he doesn't have enough deductions to get over the standard deduction. Okay, but I just want to emphasize here, take a look at line 4. There's those IRA distributions, what he's taking. This is the baseline numbers. Here's his gross income. There's his deductions, and there's his taxable income for the year. Next, let's change the situation here. And instead of George just writing a check out of his pocket to this charitable organization, he's going to do a qualified charitable distribution where that gift is going to come directly out of this IRA. Next, let's see how that changes the numbers. All right, we've updated our tax return. Let's see how the figures have changed. Okay, the first thing we want to do is come down here to line 4. IRA distributions. Remember, George was taking $36,000 out previously, and he still is. But what's different now is $5,000 of the $36,000 he's taken out went directly to charity. So let's take a look at how that's changed on things on line 4B here. This is the taxable amount of his IRA distributions. So in other words, even though he's taken $36,000 out of his IRA, because $5,000 of that was a qualified charitable distribution, only $31,000 is showing up in the taxable column. And of course, what does that do for his total income, and most importantly on line item, his gross income? Well, now it's brought his gross income down by that same $5,000, and in addition to that, it's bringing his taxable income down as well. So as you can see here, this has a pretty significant change by simply making the charitable gift directly out of his IRA instead of him having to, just writing a check out of pocket where he's getting no tax benefits whatsoever. Instead, now we're not only reducing the amount of taxes he has to pay, we're also reducing his gross income, which is going to protect him potentially from Medicare surcharges in the future. And let's say if George, was 75 years old, this would also count towards his required minimum distribution during the year. So qualified charitable distributions as a strategy it's awesome. It's really kind of the optimal way to do charitable giving if you're trying to accomplish multiple objectives here. So anyway, this is, again, the work I like doing for clients, again, projecting out their income and, not only helping them with like their charitable giving goals, but also seeing how that impacts things on the tax side. If you got any questions or want to reach out, please head over to my website. You can send me a message or schedule time to chat. Thanks for watching. We'll see you on the next one.